What the f, Zillow? If you haven't heard, Zillow is pulling out of their iBuying business, Zillow Offers. They're firing 25% of their workforce and trying to sell 7,000 homes in their inventory at an estimated loss of $500 million. Their iBuying segment dragged their earnings down, and Zillow reported a loss of 95 cents per share, far away from the analyst expectation of a 16-cent per share profit, and now the stock is in freefall. CEO Rich Barton said in the earnings press release, "Our observed error rate has been far more volatile than we ever expected possible, and makes us look far more like a leveraged housing trader than the market maker we set out to be." Translation: we didn't model our risk correctly. We've determined the unpredictability in forecasting home prices far exceeds what we anticipated, and continuing to scale Zillow Offers would result in too much earnings and balance sheet volatility. Translation: our Zestimates are so broken, but let me blame it on the market. Zillow experienced higher conversion rates than previously observed in Zillow Offers as a result of unintentionally purchasing homes at higher prices than our current estimates of future selling prices. Translation: something went terribly wrong in our purchasing process. If you combine all that with this little quote from 2019, I think I understand what really happened here. Zillow announced back then, "We hope to be purchasing 5,000 homes per month in the next 3 to 5 years. This smells like a major management f*** up and exposes some critical flaws in the Zestimate pricing model too. You see, when you've got a boatload of cash and you have to go on an acquisitions rampage to become the market leader, and then you pressure your team by telling them the most important measure of success is volume, the only way to hit those numbers is to lower the return thresholds on your acquisitions." So when Rich Barton said, unintentionally purchasing homes at higher prices, that sounds to me like management said to their employees, go buy X number of homes or bad things will happen to you. And the employees probably thought, wow, we are paying way too much here, but that's what management wants. I mean, we got the cash, so we better hit the numbers so we can keep our jobs. So reading between the lines, when Barton said unintentionally, he probably means unintended consequences of choosing to maximize the wrong KPI. But there's another layer of complexity here with the Zestimates model. No other company has more residential real estate data than Zillow, and for Barton to say their observed error rate has been far more volatile than we ever expected possible is not only disappointing, but he should be embarrassed. I once did a massive data study to try to predict condo pricing in Manhattan using Zillow's own data. For a tiny 4-block chunk in Manhattan, my team gathered 24,000 historical data points on every apartment in that radius that we could find. And then we layered 50 years of every macroeconomic data set that we thought might be relevant, and we created a machine learning model to see how accurate it could be. Before I tell you the results, you should know that pricing condos in Manhattan is ridiculously easy for a broker. You look at the same apartments sold for the floors above and below, and then you take the average. That's about it, and you'll be accurate to maybe within 5% of the final closing price. Our machine learning model's best error rate was around 30%. Yeah. Embarrassing, and I haven't touched it since. The most important thing I learned from that exercise was that there are local forces that affect pricing that simply cannot be quantified. Like the number one driver of residential price volatility is big companies moving in or out of a city. But only the real estate people in these companies know those plans beforehand, and they usually don't go public until a deal is done. So there's no data set for it. I think Zillow's data team had a huge blind spot here, fueled by management hubris. Ask any seasoned broker or house flipper, and they understand what the volatility and risks are. But when Rich Barton says, more volatile than we ever expected possible, that reeks of overconfidence in their Zestimates model. And frankly, to blame the market without having the introspection to realize your management structure and tech is broken is ignorant and shameful. Between Zillow Offers shutting down and Katera closing up earlier this year, this really drags on the reputation of PropTech, and it's just upsetting. I'm gonna go brood in a corner now.